What if I told you that right now, in this very moment, we're witnessing one of the most significant wealth transfer opportunities in precious metals history, and most people are looking in completely the wrong direction? While everyone's celebrating gold hitting new all-time highs, I'm doing something that might sound absolutely insane to traditional investors. I'm selling my gold to buy silver at $76 an ounce, and by the end of this video, you're going to understand exactly why this could be the most profitable decision I've ever made. But here's the thing that should terrify every gold investor right now. There's a mathematical ratio that's been screaming a warning signal for the past 3 years, and when this ratio corrects itself, and it always does, the move in silver could be so explosive that missing it would haunt your portfolio for decades. Stay with me, because what I'm about to reveal involves insider market dynamics that Wall Street desperately doesn't want you to know about. Before we dive into the shocking data that changed my entire investment strategy, make sure you hit that subscribe button and turn on notifications, because we're about to explore financial territory that could genuinely transform your wealth trajectory. Now, the information you're about to hear isn't financial advice, but it's based on decades of historical patterns, current supply and demand fundamentals, and macroeconomic trends that are converging right now in a way we haven't seen since the 1970s. And if you remember what happened to silver in the 70s, you know exactly why your full attention for the next few minutes could be worth tens of thousands of dollars. Let me start with something that's going to sound controversial. Gold might be the most overvalued it's been relative to silver in modern financial history. Now, I know what you're thinking. Gold just hit $3,000 an ounce. It's breaking records. Central banks are buying it at unprecedented rates. How could it possibly be overvalued? Here's where things get interesting. There's a metric called the gold to silver ratio, and right now it's sitting at approximately 85 to 1. That means it takes 85 ounces of silver to buy 1 ounce of gold. To put this in perspective, the historical average over the past century has been around 50 to 1. During stable economic periods, it's been as low as 30 to 1. But here's where your jaw should drop. The natural geological ratio of silver to gold in the Earth's crust is roughly 15 to 1. We're currently trading at a ratio that's nearly 6 times higher than what nature actually produces. What does this mean in practical terms? It means that silver is historically, geologically, and mathematically undervalued compared to gold by a staggering margin. And history has a brutal way of correcting these imbalances. Let me take you back to 2011. The gold to silver ratio hit similar extreme levels, trading above 80 to 1. Then something remarkable happened. Silver exploded from around $25 to nearly $50 in just a few months, while gold barely moved in comparison. The ratio compressed violently back toward 45 to 1. Early investors who recognized this pattern and shifted from gold to silver saw returns that absolutely destroyed what gold holders experienced during the same period. But that's nothing compared to what happened in the 1980s. In 1979 and 1980, we witnessed perhaps the most dramatic precious metals move in modern history. Silver went from around $6 an ounce to $50 in less than 2 years. That's more than an 800% return. Gold certainly performed well during this period, rising from around $300 to over $800, but silver's percentage gains demolished gold's performance. The investors who positioned themselves in silver before this move didn't just make money, they generationally changed their family's financial trajectory. And here's the kicker that should make every investor sit up and pay attention. The fundamental conditions that preceded that explosive move are eerily similar to what we're seeing right now. But let's talk about something that the mainstream financial media barely mentions because it doesn't fit the narrative they want to push. Industrial demand for silver is at levels we have never seen before in human history, and it's accelerating at a pace that's frankly terrifying for anyone concerned about future supply. Gold is primarily a monetary metal. Yes, it has some industrial uses, but roughly 90% of gold demand comes from investment and jewelry. Silver is the complete opposite. Over 60% of silver demand is industrial, and that percentage is growing every single year. Why does this matter? Because industrial demand is inelastic. When a manufacturer needs silver for their products, they can't just decide not to buy it if the price goes up. They need it, period. And right now, 3 massive industrial trends are creating a perfect storm of silver demand. First, let's talk about the electric vehicle revolution. Every single electric vehicle requires substantially more silver than a traditional combustion engine car. We're talking about silver in the electrical contacts, in the battery management systems, in the charging infrastructure, in the solar panels that increasingly power these vehicles. The International Energy Agency projects that EV sales will reach 65 million units annually by 2030. Each one of these vehicles requires anywhere from 25 to 50 grams of silver, and some estimates go even higher for fully loaded EVs with advanced driver assistance systems. Do the math. That's potentially 3,000 metric tons of silver demand just from EVs alone, and that number is growing exponentially year over year. To put this in context, total annual silver mine production is only about 25,000 metric tons globally. The EV revolution alone could consume more than 10% of global silver production within the next few years. Second, the solar energy boom is absolutely devouring silver at an unprecedented rate. Every solar panel requires silver paste for the photovoltaic cells that convert sunlight into electricity. There's currently no economically viable substitute that matches silver's conductivity and efficiency. The Silver Institute estimates that solar panel production consumed over 160 million ounces of silver in 2023. And this number is projected to explode as countries race to meet their renewable energy commitments. China alone is installing solar capacity at a rate that was unimaginable just 5 years ago. The United States, through the Inflation Reduction Act, is massively subsidizing solar installations. Europe is desperately trying to reduce its dependence on foreign energy. Every single one of these solar panels being installed contains silver that's gone forever, never to be recycled or returned to the market. Third, and this is something most investors completely overlook, the electronics and technology sector continues to demand more silver for everything from smartphones to 5G infrastructure to artificial intelligence data centers. As our world becomes increasingly connected and digital, the demand for silver in electronics is structurally increasing. Every smartphone contains a small amount of silver. Doesn't sound like much until you realize that over 1 billion smartphones are sold globally every year. 5G infrastructure requires significantly more silver than 4G because of the increased number of base stations and the more sophisticated electronics required. And here's something that should absolutely blow your mind. The artificial intelligence revolution that everyone's talking about requires massive data centers filled with servers that use silver in their components and connections. NVIDIA, the company that's become synonymous with AI chips, is building technology that relies on materials like silver for optimal conductivity and performance. Now, let's connect these dots in a way that reveals why I'm selling gold to buy silver right now. All of this industrial demand is inelastic and growing, but here's the shocking part that most people don't understand. We're simultaneously facing a supply crisis and silver that's getting worse every single year. Global silver mine production peaked in 2015 at about 900 million ounces and has been in decline ever since despite higher prices. Why? Because most silver, about 70%, is actually a byproduct of mining other metals like copper, lead, and zinc. This means that silver supply is largely dependent on the economics of these base metal mining operations, not on the price of silver itself. Even with silver at $76, if copper mining isn't profitable or if environmental regulations restrict lead and zinc mining, silver production suffers. The Silver Institute has reported that we've been running a structural supply deficit for years now. What does a supply deficit mean? It means that total demand for silver exceeds new mine supply and recycling. Where's the difference coming from? It's coming from above-ground inventories that have been built up over decades. But here's the terrifying reality. Those inventories are being depleted at an alarming rate. COMEX silver inventories, which represent the silver available for delivery in the futures market, have dropped dramatically over the past few years. Registered silver, which is the silver actually available for delivery, has hit levels that have veteran traders genuinely concerned about the possibility of a supply squeeze. And when a supply squeeze happens in a market as relatively small as silver, the price moves can be absolutely explosive. Let me put the size of the silver market into perspective because this is crucial to understanding why the upside potential is so enormous. The entire above-ground investable silver market is worth somewhere around $50 billion at current prices. That might sound like a lot until you compare it to gold, which has an above-ground investable market worth of over $12 trillion. Silver's market is roughly 240 times smaller than gold's. Now, here's where things get really interesting. What happens when just a tiny fraction of investment money decides to flow into silver instead of gold? The price impact on silver is magnified enormously because the market is so much smaller. If even 1% of global gold holdings decided to rotate into silver, it would completely overwhelm the available supply and send prices absolutely parabolic. Some of you might be thinking, okay, this all sounds compelling, but isn't this just speculation? Where's the proof that silver actually outperforms during precious metals bull markets? Let me take you through some historical data that's going to change how you think about portfolio allocation. During the 1970s precious metals bull market, gold rose from $35 to $850, an incredible gain of roughly 2,300%. But silver? Silver went from around $1.30 to $50. That's a gain of over 3,700%. Silver didn't just outperform gold, it crushed it by a margin of over 60% in percentage terms. Fast forward to the 2000 to 2011 bull market. Gold went from around $250 to $1,900, a gain of about 760%. Silver went from around $4 to $49, a gain of over 1,200%. Once again, silver significantly outperformed gold on a percentage basis. But here's what makes the current setup even more compelling than those historical precedents. Back in the 70s and in the 2000s, we didn't have this explosive industrial demand story. The EV revolution didn't exist. The solar energy boom was in its infancy. The AI data center build-out hadn't even been conceived. The industrial demand for silver today is structurally higher and growing faster than at any point in history, while simultaneously we're dealing with declining mine production and depleting inventories. This is a fundamental setup that's arguably more bullish than anything we've seen in the past 50 years. Let's talk about the macroeconomic environment, because this is where gold bugs and silver enthusiasts should actually be on the same page, but with one critical difference. We're living through a period of unprecedented monetary expansion, massive government deficits, and currency debasement on a scale that would have been unimaginable just 20 years ago. The United States alone has added trillions of dollars to its national debt in just the past few years. The Federal Reserve's balance sheet, despite recent reduction efforts, remains at historically elevated levels. This is exactly the kind of environment where precious metals traditionally thrive as a hedge against currency debasement and loss of purchasing power. Gold has certainly responded to this environment, hitting new all-time highs. But here's the critical question. If gold is already at all-time highs and silver is still trading at less than half of its 1980 peak when adjusted for inflation, where's the better risk-reward ratio? Think about this for a moment. In real, inflation-adjusted terms, silver would need to hit somewhere around $140 just to match its 1980 peak. We're currently at $76. That means silver has potentially 84% upside just to reach its previous inflation-adjusted high, while gold is already trading above its inflation-adjusted peak from 1980. From a risk-reward perspective, this setup is screaming that silver has dramatically more upside potential than gold at current levels. And this doesn't even account for the new industrial demand dynamics that didn't exist in 1980. Now, let me share something that's going to sound like a conspiracy theory, but it's actually well documented and has resulted in multiple legal settlements. The silver market has been subject to manipulation and suppression for years by major banks and financial institutions. In 2020, JP Morgan Chase paid a $920 million settlement for spoofing and manipulation in precious metals markets, including silver. Multiple traders were convicted of criminal charges related to these schemes. The Bank of Nova Scotia, Deutsche Bank, and others have also settled manipulation claims related to silver. Why does this matter? Because if the price has been artificially suppressed through illegal trading practices, and those practices are being cracked down on and curtailed, what happens to the price when it's finally allowed to trade freely based on actual supply and demand fundamentals? The geopolitical situation adds another layer to this thesis that most people aren't fully appreciating. We're living in an increasingly multipolar world, where trust in traditional financial institutions and fiat currencies is eroding. Central banks, particularly in countries like China, Russia, India, and others, have been accumulating gold at record rates as a way to diversify away from dollar dependence. But here's something interesting that's starting to happen. Some analysts are noting increased interest in silver as well, particularly as industrial powerhouses recognize that controlling silver supply could provide strategic advantages in the renewable energy and technology sectors. China, for instance, dominates solar panel production and is one of the largest consumers of silver. They understand better than anyone the strategic importance of this metal for future technologies. Let me paint a scenario for you that keeps me up at night with excitement. Imagine you're a large institutional investor or a sovereign wealth fund watching the silver market. You see the supply deficits, the declining inventories, the explosive industrial demand, the historical undervaluation relative to gold, and the relatively tiny market size. You recognize that silver at $76 represents potentially the last opportunity to accumulate a meaningful position before industrial demand completely overwhelms available supply. What happens when you try to buy, say, $1 billion worth of physical silver? In a $50 billion market, that's 2% of the entire market. The price impact would be enormous. The market simply cannot absorb large institutional buying without dramatic price increases. This is why some analysts believe that when the real move in silver begins, it won't be a steady climb. It will be a vertical spike that leaves late investors completely behind. There's also the opportunity cost consideration that many gold investors aren't calculating properly. Let's say you believe, as I do, that we're in a long-term precious metals bull market driven by monetary debasement, geopolitical uncertainty, and loss of confidence in fiat currencies. If that's your thesis, the question isn't whether to own precious metals, it's which precious metal offers the best risk-adjusted returns from current levels. If gold rises another 50% from current levels to $4,500, that's certainly a great return. But if silver rises to match its inflation-adjusted high of $140, that's an 84% gain from current levels. And if silver experiences the kind of explosive move it had in 2011 relative to its starting point, we could be looking at gains that dwarf anything gold can deliver simply because gold is already at all-time highs, while silver is still deeply undervalued on multiple metrics. Some of the most respected analysts and investors in the precious metals space are making similar arguments. Rick Rule, a legendary resource investor, has repeatedly stated that silver offers better return potential than gold at current valuations. Mike Maloney, author of Guide to Investing in Gold and Silver, has been pounding the table on the gold to silver ratio being at extreme levels that historically precede explosive moves in silver. Technical analysts point to long-term charts showing silver in a massive multi-decade base formation that, if broken to the upside, could lead to a move that surprises even the bulls. These aren't random internet commentators. These are people who have made fortunes understanding precious metals, cycles, and market dynamics. Let's also discuss the practical aspects of portfolio construction and why silver might make more sense for many investors than gold at current prices. Silver is more accessible for smaller investors. At $76 an ounce, an investor with a few $1,000s can accumulate a meaningful position in physical silver. Gold at $3,000 an ounce requires much more capital to build a position. Silver's higher volatility, while certainly a risk, also presents opportunities for greater returns. For investors willing to accept higher volatility in exchange for higher potential returns, silver offers a better risk-reward profile than gold at current levels. And from a diversification standpoint, holding both metals makes sense, but the allocation should reflect current valuations and future potential, not just tradition or conventional wisdom. The mining sector tells an interesting story as well. Silver mining companies are trading at valuations that seem absurdly low relative to the price of silver and their potential earnings growth. Many silver miners are generating free cash flow at current silver prices that would support stock prices multiples higher than where they're currently trading. If silver does experience a significant price increase, the leverage in silver mining stocks could be extraordinary. Historically, silver mining stocks have outperformed the physical metal during bull markets, sometimes by factors of 3 to 5 times or more. For investors comfortable with the additional risks of equities, silver miners could offer even more explosive upside than the physical metal itself. Here's something that might surprise you. Industrial users of silver are actually worried about future supply in a way they haven't been in decades. There are reports of some manufacturers beginning to stockpile silver because they're concerned about availability and future price increases. When end users start hoarding a commodity, it's usually a signal that the market is tighter than official statistics suggest. This prepositioning of inventory by industrial consumers removes supply from the market and can create a self-fulfilling prophecy where concerns about shortages actually create shortages, which then drive prices higher, which then validates the original concerns. We've seen this dynamic play out in other commodity markets, and the early signs suggest it might be beginning in silver. The technological demand for silver continues to evolve in ways that could dramatically increase consumption beyond current projections. Emerging technologies like hydrogen fuel cells, advanced water purification systems, and even certain medical applications are finding new uses for silver's unique properties. Silver is the most conductive metal for both electricity and heat. It has natural antibacterial properties, and it's highly reflective. These characteristics make it irreplaceable in many applications. As technology advances and new applications are developed, structural demand for silver could increase even beyond the already impressive projections for EVs, solar, and electronics. From a contrarian perspective, the fact that silver remains so unloved and underowned by mainstream investors might actually be the most bullish indicator of all. When you mention silver to most financial advisors or institutional investors, you often get eye rolls or dismissive comments about it being too volatile or too small a market. This widespread skepticism and lack of institutional participation means that silver ownership is nowhere near the levels you'd expect to see at a market top. In fact, silver ownership as a percentage of global financial assets is probably at or near historic lows. What happens when this narrative shifts and silver becomes the hot investment that everyone wants to own? The rush into such a small market could create price moves that seem impossible from today's vantage point. Let me bring this full circle to why I personally am selling gold to buy silver at $76. It's not because I think gold is a bad investment. Gold will likely continue to perform well in the current macroeconomic environment. But at current valuations, and given the setup in silver, I believe silver offers dramatically better return potential over the next 3 to 5 years. The gold to silver ratio at 85 to 1 is mathematically and historically extreme. The industrial demand story for silver is unprecedented and accelerating. The supply situation is deteriorating despite higher prices. The market is small enough that even modest new investment demand can move prices dramatically. The historical precedent shows that silver consistently outperforms gold during precious metals bull markets. And the current macro environment of currency debasement, government deficits, and geopolitical uncertainty is exactly the kind of backdrop where precious metals thrive. This is not a get-rich-quick scheme or a short-term trade. This is a strategic positioning based on fundamental analysis, historical patterns, and recognition that we're witnessing the convergence of multiple bullish factors that rarely align this perfectly. Silver at $76 might seem expensive compared to where it was 5 years ago, but compared to where it could be going based on supply-demand fundamentals and historical valuation metrics, it might actually be the opportunity of this decade. The risk-reward ratio, when analyzed objectively, and without the bias that gold is always the safer precious metal, heavily favors silver at current levels. So here's my challenge to you. Don't just take my word for it. Look at the data yourself. Examine the gold to silver ratio historically. Research the industrial demand trends for EVs, solar, and electronics. Investigate the supply situation and declining mine production. Study what happened to silver during previous precious metals bull markets. Calculate the inflation-adjusted high that silver would need to reach to match its 1980 peak. And then ask yourself honestly, where's the better opportunity right now? Gold at all-time highs or silver at half of its inflation-adjusted peak with explosive new industrial demand that didn't exist in previous cycles? The decision I've made to sell gold and buy silver isn't based on hope or speculation. It's based on cold, hard analysis of market fundamentals, historical precedent, and recognition that opportunities like this don't come along very often. When the gold to silver ratio is at extreme levels, when industrial demand is setting records, when supply is declining, when inventories are depleting, and when the metal is still dramatically undervalued relative to its historical inflation-adjusted peak, the intelligent move is to position yourself accordingly before the rest of the market wakes up to the opportunity. If this analysis has challenged your thinking about precious metals allocation or opened your eyes to the opportunity in silver, make sure you like this video, leave a comment with your thoughts on the gold versus silver debate, and subscribe to the channel because we're going to be following this story closely as it unfolds. The silver story is just beginning, and the next few years could be absolutely transformative for investors who position themselves correctly. Remember, the best investments are often the ones that seem controversial or contrarian at the time you make them. Everyone loves gold right now. Very few people are talking about silver, and that's exactly why silver at $76 might be the opportunity that defines this precious metals cycle. Don't let this moment pass you by.